Hi everyone, this is Bruce over at Fleet Capital Management in Bellingham, Washington, about 80 miles north of Seattle and about 10 minutes south of the Canadian border over on the Pacific Northwest coast. Today is the 4th of February, 2016. We're going to spend a few minutes together taking a look back at January of 2016. January was a difficult market any way you want to look at it. It was just a difficult time. What you'll see here is that each one of these bars, if you will, they're called candlesticks, represents one day, one business trading day in January. So what you can see from the beginning of January is that this market pretty much went straight down for the majority of the month. On January 22nd, it then decided to go sideways. It was just an every other day. This was an up day. This was a down day. This was an up day. This was a down day. This was an up day. And then last Friday, the end of January, the 29th, we had a very, very powerful up day. Do remember that when we're in a bull market, a rising market, we will have down days, maybe even down weeks. When we're in a bear market, we can have up days and up weeks. So it's really important to understand that a trend is not made from one day. When I talk about a trend change, let me show you or direct your attention here. These lines represent what are known as exponential moving averages. This red line is a 200 period moving average. And the reason I say period is that on this particular chart, each bar, each candle represents one day. So that would be 200 days. Most of the charts that I use when I'm trading are 1 minute charts. So then each bar represents 1 minute and I get updated every 15 seconds. So then this 200 period would be 200 minutes. So that's why we call it a period moving average. So the red is 200 periods. The blue is 50 periods. The green is 20 periods. Now, what I want to direct your attention to is back around the 7th or 8th of January, the blue, which is the 50 period moving average, crossed below the 200 moving average. And what that signifies, technically speaking, is a bear market. And I believe I sent out an email or some type of a blast letting you know that my indicators just indicated we are now in a bear market. How long will that bear market last? Until it ends. And I don't mean to be flippant, but no one knows. I will tell you that throughout history, bear markets are shorter than bull markets, but sometimes they can be much more dramatic and much more difficult to deal with. So let's look a little bit further. So here's January, difficult to say the least. One of my favorite lines, and you know I'm a trend trader, is that we have to trade the market that we're given, not the one that we want. We all want an upward sloping bull market that just stays intact for 2 years. We make a ton of money. Even if we had a steady bear market where it was sloping down and we could make money on that side. So those would be optimal. We don't have that right now. What we have right now is a trendless bear market. I'll show you what that means in a minute. And it's just, we have to deal with what we're given, not really what we want. So here is a chart, and this is what I was saying. This is a minute by minute chart. So each one of these lines represents 1 minute. And this was today's chart. And as you can see, you can't see to the left, but the market, let me get a little drawing thing here. The market opened down fairly significantly and then had a very quick retracement back to the upside, and then it turned and went down again, and then it went back up, and then it went down, and we'll even give this a little bit more down, and then it went back up. So when I say we're in a long-term bear market, that doesn't mean that every tick on the chart goes down. This was a trendless market today. This dashed blue line, what you can see here, represents where the market opened, and that just stays static on the chart. So I can see how we're doing relative to the open value. And you can see we just kept flip-flopping around the open. Well, there's no trend there. We did put on a trade. We're trying to make a little bit of money in this kind of a crazy market, but it is difficult to say the least. Let me go to another screen and show you. Let's see here. Bear with me. I'm still getting used to some of this new technology. I love technology, but getting used to how it works is a little slow for a guy like me sometimes. So this is also today's market, and you can see this is yesterday's market. This was Wednesday the 3rd, pardon me on that. And what I wanted to show you was we had a cross right here where the blue 50-period moving average moved below the 200 period. And I made an inverse purchase for my trading account clients right there. You can also see, it's very, very difficult to see, but these are volume bars. And I saw an uptick in volume. I've got my little circle there, which to me confirmed this. I did an inverse trade. An inverse trade is a security that benefits when the market falls. I know that sounds crazy. It's just inverse of what a normal bull trade is. But I made a purchase of an inverse trade for you, and we did pretty well. You know, the market continued to go down right until it stopped, and then it started to go back up. We got out of the trade where this circle is, somewhere in that area. And in a couple of minutes, I'll show you how we made money on that. But again, we're seeing very difficult trading markets. One of my favorite sayings as a trend trader is the trend is your friend until it ends, and it bends. Here's an example. This is just a blow up of what we were talking about. I saw the 50 go below the 200, saw a little uptick in volume here on a down move. The trend is your friend. We're riding the trend all the way down. We're making a little bit of money here. We made a couple of percentage points. The trend's your friend till it ends, and it bends, and it turns back the other way. So again, that's the kind of market that we're in right now. Some of you are probably like me. In some ways, we love the new technology days, but in many ways, we miss the old days. The old days, when our TV got fuzzy, my dad would send me over the TV and tell me just to hit it until my hand hurt. And almost invariably, it would clear up the picture. So I think as a guy who grew up in that time frame, I still want to hit things and make them right. But unfortunately, I can't. I have a number of computers on my desk, and I should probably set up a time-lapse video so you can see how many times I bang my head against the desk or the wall, or get up and walk around and cry every once in a while. This is a tough market. This is a very, very tough market, and everybody's feeling it. I subscribe to quite a few very famous trend analysis systems where for certain extra money, which I pay, the firm pays, is I get their commentary, whether it's live on the phone or it's mostly webinars that we do pretty much every day, and they're only for people who subscribe. So I get these top technicians from around the country who are just brilliant guys, been doing this a long time. To a person, everybody's saying the same thing. We're in a difficult market. Nothing we can do about it except for protect ourselves on the downside, try to pick up a few percentage points and make a little bit of money while it's bouncing around, and wait for a real trend to develop. So that's what we're going to do. And that's why I say how I long for the good old days, not just the bad TVs. But remember, I came into this industry in the mid-1980s. In the mid-1980s, we didn't work very hard. We pretty much just sat back in our chairs for the 80s and the entire decade of the 90s, except for a few blips, and watched as our clients and ourselves, we just continued to make money. I remember the days when we were the, what did they call it in Titanic? The master of the universe, or the king of the universe. I don't remember what they said. I do long for those good old days. So how did we do in this market environment, which is a difficult market environment? We did pretty well. This is a performance summary for the trading account clients, and I just pick up one to grab it and give you some examples of how we're doing. First of all, month to date, so for the month of January, we did pretty well. We lost money. We lost 0.95%. but the S&P and the Dow lost significantly more. This is the Dow, the darker blue, and this is the S&P, the lighter blue. Maybe I'll try to get different colors next time. It's a little bit hard to read, but the market was down 5 to 5.5%. We were down 0.95%, and that includes all management fees, all trading costs. Everything is in there. So we actually, from our trades, did better than this, but there's costs involved in trading and management. But with all that said and done, on a net basis, we beat the S&P 500, and that's kind of the goal. Quarter to date is exactly the same because we don't have a full quarter after March 31st. This number will change, and this will keep being updated once a month. This is called an equity line, and for this particular client, this green line is this person's account, and these lines down here, there's two of them, a little bit hard to see, are the S&P and the Dow. So again, when the market really started to tumble in the beginning of January that I showed you, we held our own. We were doing some trades, a couple went up a drop and a couple went down a drop. But for the most part, we did really well avoiding that terrific downdraft. And I will tell you that now that we've been working this system for a number of months, since August 1st, I have become exceedingly confident in our management of the downside. I don't think, and most of you listening have been clients for 10, 20, 25, 30 years, I don't think that with this system we will ever again experience a 1987 crash, a 1991 recession. I mean, we could just go on and on and on. The 2000 Y2K drop off, the recession in 2008, which was devastating. The markets lost 50% of their value. I think I have so many risk controls built into this system now that I don't believe we will ever again, ever experience a downdraft like we've had during those times. Will we lose money? Yeah. You can see this green line went down just a little bit. Remember, I told you we were down 0.95%? But that's kind of it. I'm not sure. And even then, even during that period, we outperformed the S&P 500. Now, we haven't had an opportunity yet to really show how we will outperform on the upside because we haven't had a bull market. We also haven't had a steady down market. If we did, I would suggest to you, and no promises, I'm not allowed to do that, but I would suggest to you that if we do run into, if this bear market gets as bad as some people are suggesting, I would suggest to you that this green line will start to rise. It won't, it would be great. It's fine if it stays here and the market itself keeps going down. We're all very happy not losing money. But optimally speaking, and what we really want to do is we want this green line to go up if these market lines go down significantly further. And I will tell you this, no one has a crystal ball, but it's looking like we may be headed into a bear market for some part, and it may be all or just a few months, I don't know yet, of 2016. Earnings are coming in fairly poorly. Japan just went to negative interest rates. Oil prices have collapsed. A lot of stuff going on in the Middle East. We had 7 years of an up market, so there were lots of things that went in our favor. This is pretty normal. And again, in this normal bear market, we want to either hold our own or we want to make a little bit of money. That's what we want to do. That's the goal inside of a bear market. Let me show you the medium trend account. Let's see how I can get there. Bear with me again. Okay, so here's the medium trend account. Medium trend account has some mutual funds in it, so it performs a little bit different. It did not perform as well, but you can see it's down 2%, where the market's down 5.5%. And it's down a little bit more since inception. And that's because about 15% of the account is in mutual funds. Now, if the market were going up, this would work in the favor of the medium trend. Again, here we outperformed significantly the S&P, and even now we're outperforming the S&P. You'll see in this green line not as many movements up and down as we did. Let me go back to the other chart. See these? Because in the trading account, I do many more short-term trades. We're trying to get this to bend up, doing some short-term trading. And it is a little bit, but not a lot. So that's the difference there. In the trading account, even if we just keep going sideways, I'm going to be making bull trades and inverse trades and doing everything I can to get us to make money even in this sideways market, which is, like I said, terribly difficult to do. But we're holding our own and we're doing fine. Let me see if there was anything else. Oh, trend analysis for tomorrow. So let me close out of this screen. Bear with me. I'm going to stop my screen share just for a second. And then I'm going to come back and give you my desktop. And we will close that. And we will go to my desktop. So this is one of the chart programs that I use on a daily basis. This one is a daily chart. And what that means is each bar is one day. And this goes back to, here's the beginning of 2015 over here, and here's a little bit of the end of 2014. And again, the blue, the heavy blue, is the 50 period moving average, and this is the 200 period moving average. And you can see right up until August, when we had that major collapse, we were still in a bull market. 50 over 200 is a bull market. That's what so the shorter term moving average is higher than the longer term moving average. That's an up market. You can see here that the 50 started to slow down, and then we got hit with August. There was the August bear market, which thank God we had this system up and running, because this was an enormous drop-off that would have been very painful. Then the market snapped back up a little bit. And remember I told you where we went into the bear market. This was a cross, and this is called a death cross. This was back in August that showed we were in a bear market, but then the blue line went back up and crossed the red, or the 200, which signifies we're out of it, but then it couldn't hold, which is a very bad sign that it couldn't hold above, and it started to break down again. What you'll see is that the market retested, which is what we call it, the lows that we had back in August. Now, let me see. Pardon me 1 second. I'm going to see if I can get my drawing tool back up. I've lost it. Okay. Don't know where it went. So we went back down in January, and we tested those August lows. And actually, we went a little bit lower, but that's okay. Since then, you can see big up bar, clear, big down bar, red, big up bar. This means an up day, down day, kind of a non-committed day. Here was Friday, was a huge up day, and then it came back down, and so on. So we're just flopping around without really seeing much of a trend. This black line is a trend line indicator, and when it's over the number 25, it says we're in a trend. But right now it's the red line, which isn't quite over, which would signify we're in a downward trend. The green would be in an upward trend, but be that as it may. Let me show you something else that I do that you may find interesting. I'm going to grab another computer on my desk. You're now seeing a different computer on my desk, and this is RMO, or Rahul Mohindar oscillators. Rahul is a fantastic technician in India. I follow a tremendous amount of his work, and what this is, and I've updated this for today, I just want to give you an idea of some of the things I work on. This is what I would be working on late every afternoon to try to get a feel for what we might expect tomorrow and in the longer term. Let me make this a little bit bigger for you so you can see. This is called a trend detector or a trend indicator. Each bar is one day. The open for the day is always on the left, and the close for the day is always on the right. So on this particular day, we closed a little bit higher than we opened. The rest of the bar is we went up much higher during the day and we went down lower during the day, but left side is open, right side is closed. Does that make sense? So here we opened, we went up some, we went down some, and then we closed. This was a down day. So that's all those bars are. The green represents a daily trend indication. The red is weekly, and the blue is monthly. So how do I read this chart, or how would you read this chart? And this is live. This is today. Today, the closing price was over the green, which is the daily part of this indicator, and under the red. It's going to be under the blue until we're in a long-term bull market, but we're under the red, and that's the weekly. So what this particular indicator is suggesting to me is that we might have another up day tomorrow. It's possible. Again, in technical analysis, there's no crystal ball. There is a windsock. And that windsock, for my pilot friends and sailor friends, boating friends, gives you an indication of the direction of the wind. It doesn't give you, to the point. But what this is saying is where we closed and the activity today is slightly bullish on a very short-term period, but still bearish on a weekly period and a monthly period. Okay, hopefully that makes sense. So that's one indicator that I use. A second indicator that I use is called the ATM, or the Automated Trend Modules, and this is just bars of the market. When the bars are green, the system is detecting an upward move. When the bars are red or orange, the system is detecting down moves. And even if we have up days, this bar here, hard to see, but this was a big up day, but the bar was still orange because we were in a downtrend. So if it's black bar, it means it doesn't know. It's not seeing anything. It's not seeing a trend. When this line is below the middle line, that's showing me the trend, the medium-term trend is down. When it's above, it means that the trend is up, and right now, again, it's flat. So everything is showing me kind of a trendless market. And this is a zone detector. This just means that there's a lot of activity going on in the market when you see these lines. There was a lot of activity to the downside, but there was a lot of volume pressure. When the zone detector looks flat like this, it just means nothing's, even though these were green bars, nothing's really happening in the market when you look at volume. It's quiet. What we call it, or what Rahul calls it, is a dormant market. So that is another study that I use. Here's one, speaking of volume. This is called a strength weakness indicator, and it really is focused about 90% on volume. And these are volume bars down on, and you can see sometimes volume is high, and sometimes it's average, and sometimes it's low. The way you read this chart is if the daily price bars, which these are below the red volume line, it indicates weakness, significant weakness. If those bars cross above the red line, it shows strength. And so right now we are still in volume weakness. And what that means is there's more money flowing into the downside of this market than there is flowing into the upside of this market. So that is a third chart that I read. A fourth one from Rahul is called Breakout Catcher. It's very, very sensitive. Blue bars means that the system itself is sensing some upward pulse. So, it's always easy when we look back. But here's today. There it is, the 4th of February. And let me tell you how I would read this, because I read these every day. I look for trends looking left, but then I look for, we just went from a khaki, which is a neutral, to a blue, which is a positive bar. We also got a breakout. This is called the breakout catcher indicator on the upside. This would be on the downside. But we are in dormant. We're down here in dormant. If we were in a hyperactive phase and I got an up bar here and a blue bar, I would strongly suspect that the market, that we're only looking one day in advance, would be positive tomorrow. But given that I've got a blue bar following a neutral bar, and I have a positive bar on the breakout catcher, which is this over here, but I'm in dormancy, I hope you can hear in my voice the trend. Nothing is being supported. Nothing is by volume. It really is just chance on an up and down movement during the day right now, which is tremendously frustrating. And then finally, this is a counter trend indicator. And the way you read this is if the market is going down and we get a blue buy, it means the rest of the indicators still think the market's going down, but this particular system is sensing some bullishness, and it was right. So you don't read all of the signals. You read the first signal after a trend. Here's a downtrend, first buy signal, you buy it. Here's a then sell, and they don't always continue on. We did have a buy signal, which I showed you towards the end of January has been moving up, and so has the first couple of days of February. But it's been very frustrating, and it really is a sideways move. So that kind of gives you an indication of where we are. And where we are is we're in a long-term bear market based on all the technicals, and I believe that the fundamentals are going to support that because earnings are coming in poorly, and there's a lot of negativity out there. Doesn't mean we won't have good days. Those are called bear bounces. They're also called, and I think I put this in an email earlier this week or last week, they're called dead cat bounces. And I hate that term, but as a cat lover, and I don't know if you can hear her, but she's laying on a rocking chair snoring behind me. So what we're seeing pretty consistently throughout everything is that we are in a bear market. We are getting some bounces, some bear bounces. We're in a sideways market. We don't have a true bear market trend showing up yet on prices. I think we will. I wouldn't be surprised if over the next week or so we continue to go sideways or have some bear bounces. And what those do is they shake out the people that say, okay, the bear market's over, I'm getting in, I'm going to buy in, I'm going to make a lot of money. Market has a way of bringing us to our knees when we get cocky like that. So what I do is instead of predicting the market, I desperately try to read what the market is telling me. What is the market doing, and what is it telling me? I'll show you one other thing. This is a risk management system that I use. This, again, is on another computer. But here is, remember I told you I got a pretty good trade the other day. Sorry for the sound effects. But when I had seen, if you remember the chart way back, I saw some volume changing and I saw a trend changing, and I bought us an inverse security, and we held it only for a couple of hours, and net of everything, we were up 2.13%. So not bad for a couple of hours. Those are the things I'm trying. But then I can also show you, because I want to be fair, the same day we went in and bought a bullish long trade, and on that one we lost 0.9%, so less than 1%. So difficult market. We are doing better than, let me put it this way, our gains are greater than our losses. Our average gains 4.7, average loss 1.1. Just in the last week, we were up 30. Don't worry about the dollars because this doesn't mean anything. This is on a hypothetical. But we made more than we lost, so we were trending higher. And I keep track of every trend that we do. So bottom line is, and I know this is going on a little bit long, but bear market, difficult market, sideways market, a lot of negativity out there. I'm going to continue trading for the trading account because those clients accept short-term, higher-risk trades. I'll continue doing this daily trading, trying to pick up some few dollars here, a few dollars there for you. In the medium trend account, I'm really not jumping in there yet until I see a little bit stronger trend. I thought I had one the other day. You may notice in the medium trend account, I did a trade. It just didn't work. I think we went down about 0.5% or 1%. But I'll keep looking for those because the medium trend needs a longer term trend. and then we'll know. One last thing before I let you go, just if these bars start to close below the green, red, and blue, and we see a trend there, then I will start buying for the medium trend accounts. Until then, because we're above the green, below the red, it's still very daily, and thus I will only do those trades for the trading account. That's it. If you have any questions at all whatsoever, please send me an email. Like I had said earlier on, if a question comes in and I think it would be useful for everyone, I will just blast email that out to everyone so everyone can have the answer to that question. But I'm always here, and please do send me your questions, and I'm more than happy to answer them. Hang tough. We're in a difficult market. We're also in the political season. If you're like me and you're a political junkie, you actually like this insanity. But this is just about more insane than I've ever seen it since I've been watching politics for about the last 40 years. So that's a story. Great chatting with you, and keep your head on straight and keep looking down the fairway. We'll do fine. Talk to you soon. Bye-bye.